Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. Many subscribers ask me to analyze Palantir stock because Palantir stock, as you may already know, has rallied a lot this year. Personally, I want to find out whether Palantir is still one of the best AI software companies for long-term investing. So in this video, I'm going to analyze Palantir stock. I will explain whether I think Palantir stock is substantially overvalued now. Just to give you more context, at the time of making this video, Palantir has been the best performing stock in the S&P 500 this year. Palantir has rallied even more than Nvidia this year. But interestingly, Nvidia's revenue, earnings, and free cash flow growth are much higher than Palantir's. So what is going on here? Why is Palantir rallying much more than Nvidia, even though Nvidia's growth has been much higher? Also, Nvidia is much more profitable than Palantir, while its forward valuations are much lower. Many investors do not know this. One of the best ways to know whether a stock is substantially overvalued or overhyped is to see how many people post their gains or hype about a stock on social media, such as Twitter, now called X. For example, many investors believe that Palantir will reach $500 per share or even as much as $1,000 per share. Or you may see that many investors speculate that Palantir may grow 10x or more from here. Of course, most of these posts are based on speculation. I remember the same thing happened in 2021. Many investors were overhyping stocks on YouTube, posting their huge gains and posting their 10x price targets on Twitter and other social platforms. This is when you know a stock is likely overhyped or overvalued. I always say this, no matter how great a business is, valuation does matter. I believe it's very important not to overpay a stock, even if it's an outstanding business. So in this video, I'm going to analyze Palantir stock. I will talk about whether I think Palantir is one of the best AI software companies for long-term investing. I will talk about whether I think Palantir is a buy, hold, or sell now. You will learn about these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about Palantir's latest financials, Palantir's biggest risks to consider, Palantir's long-term growth prospects, Palantir stock valuation, and whether I will buy Palantir stock going forward. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make. So if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing. So you will know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Palantir stock, I want to give you a quick stock portfolio update so you will know my investing strategy over time. This is one of my stock portfolios. It's separated into 3 different accounts. This is the first account. This account has been performing exceptionally well over the years because I've been investing in some of the best companies in their industries. These companies are near monopolies. For example, MasterCard, Microsoft, Visa, Amazon, TSMC, Google, Meta, and ASML are all near monopolies. It's nearly impossible to compete with them because they are the best in their industries and they all have very large economic moats. You may notice that I mainly invest in the best tech companies because the best tech companies tend to have much higher growth rates and earn the most profits compared to most other non-tech companies. I like to invest in them only when they're fairly valued or undervalued. Then I just buy and hold most of them for the long term so they can become very large multi-bagger stocks in the long run. This is the second account. The investing strategy is the same. I just keep buying and holding the best companies that are near monopolies with very large economic moats and great long-term growth prospects. For example, I have invested in Apple, Google, Visa, TSMC, Microsoft, Nvidia, and Amazon. I like to buy them only when they're fairly valued or undervalued. Then I just buy and hold them for the long term so they can grow much more over time. This is a third account. This account is newer than the two other accounts, so it will take longer for these companies to become multi-bagger stocks. If you have been following my channel, you may notice that I've changed my investing strategy since 2022. Before, during the large bull market in 2020 and 2021, I invested in many hyper-growth stocks such as Shopify, Sea Limited, Alibaba, Block, PayPal, and Coinbase. It's a good thing I didn't invest too much in these hyper-growth stocks. I realized this strategy did not work at all after the pandemic was over. I made the mistake of overpaying most of these hyper-growth stocks during the pandemic. Now, instead of investing in many hyper-growth stocks that are likely overvalued, I only invest in the best companies that are fairly valued or undervalued. Then I buy and hold most of them for the long term. The risk is much lower, especially during corrections. Here you can see that I have invested in TSMC, ServiceNow, Amazon, Nvidia, Meta, Google, Microsoft, Visa, Intuit Inc., Synopsys, Uber, SML, AMD, QQQ, and SMH ETF. I actually made a mistake recently. I made the mistake of selling Broadcom and used the money to buy SMH Semiconductor ETF and other stocks. If I had kept Broadcom instead of selling it for a quick profit, I would have made another 25% gain from Broadcom. I will need to buy back Broadcom shares later on. All things considered, I expect most of these companies will grow much more over time because they are the best in their industries. Let's talk about Palantir. I think it's very important to understand Palantir's financials and its biggest risk first. In terms of financials, Palantir's quarterly revenue has grown consistently almost every quarter over the past several years. Palantir's quarterly revenue growth did slow down a lot before. However, ever since Palantir released its AIP platform in early 2023, you can see Palantir's quarterly revenue growth has accelerated again. I will talk more about this later on. In terms of profits, Palantir has achieved very consistent GAAP profits and consistent free cash flow growth in recent quarters. This is very important because Palantir's operating profit, operating margin, and free cash flow margin will likely improve much more over time as Palantir's government and commercial businesses scale much more. Palantir has these two major business segments, government and commercial. Typically, the government business contributes about 50% to 60% of the total revenue. The commercial business contributes the rest of the revenue. At the time making this video, Palantir has a very strong balance sheet. For example, according to the latest quarter, Palantir had $4.56 billion in cash equivalents and marketable securities. In comparison, Palantir only had $0.25 billion in operating lease liabilities. This means Palantir can pay off its operating lease liabilities in advance and still have around $4.3 billion in cash left. Let's look at Palantir's expected revenue growth over the next several years, so you will understand why I believe Palantir is substantially overvalued now. This year, Palantir's revenue is expected to grow by around 29% year over year. Next year, Palantir's revenue is expected to grow by around 24% year over year. After that, Palantir's revenue is expected to decelerate and grow by around 20% year over year. I actually think these growth estimates are a bit conservative. Typically, most fast-growing software companies tend to grow between 20% and 30% each year. I believe Palantir's revenue growth should be slightly higher over the next several years because Palantir is benefiting a lot from the current AI revolution. Palantir's AIP platform has been gaining many commercial and government customers in recent quarters. More on this later. Here's the biggest risk we should consider. I believe Palantir's biggest risk is its valuation. I'm going to be very honest and blunt here. I know many investors who are very bullish on Palantir do not like what I'm about to say, but that's okay. At the time of making this video, Palantir's valuation does not make sense at all. For example, Palantir's EV to sales ratio is around 64. This is extremely high for a software company that has been growing by around 20% to 30% in recent quarters. Last time when Palantir was near its peak in December 2020, its EV to sales ratio was around 36. Palantir's forward PE is around 167, which is still extremely high. Palantir's forward PE was 218, near the peak in December 2020. Let's consider this. Realistically, if Palantir is a private company and not a public company, will you buy Palantir if you know its 4P is around 167? Will you buy Palantir if its current EV to sales ratio is around 64? Let's look at Palantir's 4Ps over the next several years. You can see Palantir's 4Ps are extremely high. At the time of making this video, Palantir's 4Ps are well above 100 over the next 2 to 3 years. These 4Ps are even higher than Tesla's 4Ps. Typically, a fast-growing software company's 4P should be around 50 to 60 and not well over 100. Palantir's EPS is expected to grow in the 20% range over the next 2 to 3 years, so these 4Ps suggest that Palantir is substantially overvalued now. Here's a comparison. You can see that Nvidia's 4Ps are much lower than Palantir's 4Ps over the next 2 years. Nvidia's EPS growth is expected to be much higher than Palantir's over the next 2 years. I believe this suggests that Palantir is substantially overvalued now, while Nvidia is undervalued now. Let's look at ServiceNow, which is another major software-as-a-service SaaS company in the enterprise AI software market. Similar to Palantir, ServiceNow is a fast-growing software company. ServiceNow's 4Ps are around half of Palantir's 4Ps. At the same time, ServiceNow's expected EPS growth is only slightly lower than Palantir's expected EPS growth over the next 2 years. So again, this comparison suggests that Palantir is likely substantially overvalued now. Here is another indicator that suggests Palantir is extremely overvalued now. According to this analyst from Jefferies, Palantir's 10b5-1 plans allow insiders to sell a predetermined number of Palantir shares at a set price and time. Of course, insiders selling shares at a predetermined price and time is very common, but if you look at Alex Karp's recent sales compared to before, you can see that his recent sales have been much larger, or more than 10 times than earlier this year. This suggests that Palantir stock is likely substantially overvalued now. Otherwise, why would Alex Karp sell many more Palantir shares than before? In terms of competition, Palantir does have many major competitors in the big data analytics market. However, I don't work in the data analytics market, so I wouldn't know which companies are closest to Palantir. According to ChatGPT, Palantir competes with defense companies such as Raytheon and Lockheed Martin's software division in the government market. In the commercial market, Palantir competes with big data analytics companies such as Snowflake, Databricks, IBM Watson, Tableau, SAP, Viva Systems, and SAS. Based on my research, I couldn't find any data analytics platforms that are very similar to Palantir's AIP, Gotham and Foundry platforms. I believe this is one of the main reasons that Palantir has been winning many commercial and government businesses in recent quarters, ever since Palantir released its AIP platform in early 2023. Based on what I know, no other products are similar to Palantir's AIP platform, Gotham platform, and Foundry platform with Ontology. If you know which competitors are closest to Palantir, please let me know in the comments below and share with everyone. Let's talk about Palantir's long-term growth prospects in the data analytics and enterprise software market. I believe Palantir will continue to be one of the market leaders in the data analytics market for many years because of Palantir's 3 most important platforms: Gotham platform for government customers, Foundry platform for commercial customers, and Artificial Intelligence platform or AIP. Based on my understanding, these 3 platforms are some of the best in the industry. Let's go for these 3 platforms. As you may already know, Palantir started off building its data analytics software called Gotham for the US government for counterterrorism, defense, and immigration. Gotham is a software platform that helps intelligence and defense agencies integrate and analyze a large amount of data and helps users make more data-driven decisions. Palantir's biggest government customers include the US Department of Defense, DoD, the US Air Force, and the US Department of Homeland Security. I believe this gives Palantir a huge competitive advantage compared to other big data analytics companies because Palantir has the domain-specific knowledge and expertise in building mission-critical software that is needed to integrate a large amount of structured and unstructured data from different sources. manage these datasets, analyze these datasets to look for patterns, and make predictions based on these datasets. For example, Gotham can help users organize and analyze many datasets from different sources, provide insights to users, make predictions with the help of AIP, and help users make actionable decisions on the battlefield and various intelligence and defense operations. I believe one of Palantir's biggest competitive advantage is that the company has a long history of dealing with the US government's extremely sensitive information and data. Not many data analytics companies have the expertise to deal with extremely sensitive and mission-critical data. This is why I believe Palantir will continue winning more contracts from the US government going forward. Palantir Foundry, powered by Ontology, is another major platform. Palantir Foundry targets large enterprise customers. Palantir Foundry is an enterprise data integration and analytics platform that was created to transform the way large enterprises manage and use their data. You can think of Foundry as a central operating system for organizing and analyzing an organization's data. Users can use Foundry's data analytics to make the organization run better, make business processes more efficient, lower operation costs, improve productivity, improve margins, and increase profits. Now, Foundry also incorporates AI models that will help users analyze data, automate tasks, and create more actionable insights. Here's an example. Imagine BMW is using Foundry to manage all the company's data across different departments and business processes. Foundry would ingest BMW's data from across the company, including design, production, sales, and customer service. The ontology would then map out the relationships between all the different parts of a car, the factories where they are made, the customers who buy them, and so on. Users can ask complex questions such as how many cars with faulty brakes were sold in the last year, or which factory is the most efficient at producing engines, or which battery supplier provides the cheapest and most reliable batteries. AIP is Palantir's most important software right now because the US government and many large enterprises want to transform their business processes, workflows, and operations using the latest AI models and AI technologies. But the biggest issue is that the US government and most companies do not know how to use AIs and LLMs to transform their organizations. Palantir is one of the few companies that know how to transform many organizations and business processes using AIs and LLMs. This is why Palantir's commercial and government businesses have been growing a lot in recent quarters. I believe this trend will continue for at least the next several years because we're still at the beginning of the current AI revolution. So what is Palantir's AIP? Palantir's Artificial Intelligence Platform, or AIP, is a software platform that is designed to bring different large language models, or LLMs, such as from OpenAI and Google DeepMind and other AI tech into their existing operational workflows and systems. AIP is built to help organizations make faster, more informed decisions by combining AI with their data and existing systems. Here's a very simple example. So imagine a security analyst using AIP to monitor for physical threats in a data center. AIP could connect the various data sources such as security cameras and sensors in a data center. Then using AI models, AIP could analyze this data in real time to identify suspicious activity. If a potential threat is detected, AIP could automatically alert the security analyst and provide them with information or suggestions to help them make a decision. Let's take a look at these recent financials. I believe these key financials suggest that there's a very large demand for Palantir's Gotham, Foundry, and AIP platforms. I said this before. Typically, a fast-growing software company tends to grow by around 20% to 30% each year. According to the latest quarterly financials here, Palantir's total revenue grew 30% year over year. The fastest growing segment is Palantir's US business, specifically its US commercial business. I believe this trend will continue for the next several years because almost all the major enterprises in the US are looking for ways to use LLMs and AIs to make their businesses run better. Palantir is one of the few software companies that know how to use LLMs and AIs to transform businesses. Palantir knows how to move AI applications and LLMs from the prototyping stage to actual productions. Here you can see that Palantir's US revenue grew 44% year over year, which is exceptional. Specifically, US commercial revenue grew 54% year over year, while US government revenue also grew 40% year over year. In terms of margins, Palantir achieved an adjusted operating margin of 38% and an adjusted free cash flow margin of 60%. These adjusted margins are some of the highest in the software industry. I believe all these high growth rates and high margins suggest that there's a very large demand for Palantir's platforms. Here's the important part you should know. If you want to know whether a software as a service or SaaS company is doing well, you have to look at the software company's Rule of 40 score. The Rule of 40 states that at scale, the combined value of revenue growth rates and profit margin should exceed 40% for healthy SaaS companies. Typically, a software company is performing well when its Rule of 40 score is well above 40 in most quarters. Each SaaS company calculates its Rule of 40 score differently. Palantir calculates the Rule of 40 by adding its latest quarterly revenue growth with its adjusted operating margin. Here, you can see that Palantir has exceeded the Rule of 40 score by quite a lot since Q4 2022. At the time of making this video, Palantir has accelerated its Rule of 40 score to 68%. This is one of the highest in the industry. Palantir's Rule of 40 score is actually much higher than most other well-established SaaS companies such as ServiceNow, Salesforce, Adobe, and Intuit Inc. Palantir CEO Alex Karp said this. He expects that Palantir will continue exceeding the Rule of 40 score and maintain high growth and high margin at the same time, without compromising one metric over another. He believes that Palantir's exceptional Rule of 40 score is a reflection of Palantir's products including Gotham, Foundry, and AIP, which I mentioned earlier. He said, "We have 44% growth in the most important market in the world, arguably not the only, but by far the most viable market in the world, while having a Rule of 68, the best in the world. And we're going to maintain the contradiction of having both high margins and high growth. It's not one or the other, they're actually interplayed, and they're not a contradiction. They power each other. That's how you have world-class products. That's what you see in our numbers." This is my prediction. Over the next several years, I believe Palantir will continue achieving well above the Rule of 40 score, maintain high growth rates and high margins in most quarters, and gain a lot more government and commercial customers for several reasons. First of all, for Palantir's government business, I believe Palantir will continue winning more contracts from the US government, especially the Department of Defense, the US intelligence agencies, and other mission-critical US departments that need to use Palantir's Gotham platform with AIP and the Maven smart system. Here's an example. Recently, right before I started making this video, the US government gave Palantir a high rating for secure cloud computing services. This high authorization will allow the US government to process more sensitive data and unclassified workloads in Palantir's cloud services, such as Palantir's Gotham platform with AIP. I believe this is a very important milestone because it shows that Palantir is getting more contracts and sustainable businesses from the US government. Moreover, it's not easy to win more business from the US government. Based on what I know, the barriers to entry are very high. Palantir often has to compete with traditional defense companies such as RTX, Boeing, General Dynamics, and Lockheed Martin to win government contracts. This shows Palantir has some of the best data analytics platforms that are very secure and reliable for most government agencies. Moreover, according to Investors Business Daily, on December 6th, Palantir announced a partnership with federal defense contractor Booz Allen Hamilton to modernize IT infrastructure and accelerate defense mission innovation. Early this year, Palantir secured larger contracts with the Department of Defense to expand its AI program called Project Maven. Here's the important part you should know. Right now, there's an AI arms race between the US and China. This AI arms race will continue for many years. Both the US and China are racing to become the dominant leader in AI, advanced chip manufacturing, advanced chip design, and other leading-edge tech because of national security concerns. The countries that have the most advanced AI systems and AI technologies will have a huge competitive advantage in both military and commercial businesses. This is why the US government, especially the Department of Defense and the US intelligence agencies, will continue investing in many AI technologies and AI platforms, such as Palantir's Maven Smart System going forward. I believe this AI arms race will continue to benefit Palantir because Palantir has developed some of the most important software platforms, such as Gotham and the Maven Smart System for the US government. Moreover, the US government is expected to expand Palantir's software platforms, such as the Maven Smart System, to other defense and intelligence departments going forward. The commercial business will be another major growth catalyst for Palantir going forward. Typically, the government business contributes about 50% to 60% of Palantir's total value each quarter, and the commercial business contributes the rest of the revenue. This is my prediction. Over the longer term, Palantir's commercial business, especially its US business, will eventually become the company's largest growth driver. Here's why. I said this earlier, right now, almost all the major enterprises are looking for ways to integrate the latest LLMs and AI models into their business operations and business processes so that they can run their businesses better, reduce operating costs, improve employees' productivity, improve margins, introduce new products and services, improve their existing services, increase their revenues, and of course, improve their profits. One of the biggest issues is that most companies do not know how to use AIs and LLMs to improve their businesses. Most companies do not know how to earn high returns on their AI investments or ROIs on their AI investments. Now, there's a huge misunderstanding when it comes to AIs and LLMs. Many companies think that they need to create a killer AI app like OpenAI's ChatGPT to earn high ROIs on their AI investments. This is a huge misunderstanding. There's a way to earn much faster ROIs on AI investments, and that is integrating AIs, LLMs, AI-powered analytics, and AI agents in their existing business processes and workflows. This will help large organizations reduce operating costs, improve business processes and workflows, improve productivity, improve margins, increase sales on their existing products and services, and increase profits. For example, by using Palantir's AIP, these companies have improved their workflows, decreased operating costs, improved productivity, and earned higher ROIs on their AIP investments. One of Palantir's biggest growth strategies is running AIP bootcamps for potential customers who are interested in using Foundry and AIP to transform their businesses. Based on my understanding, these AIP bootcamps have been very effective in converting many commercial customers from the initial bootcamp to seven-figure deals and then to enterprise-wide integration and expansion within several months. I mentioned this earlier, very few companies know how to make practical use of LLMs and AI applications in actual workflows and business operations. I think this is why Palantir has been winning many commercial clients in recent quarters. I believe this trend will continue for at least the next several years because of Palantir's AIP, Foundry with Ontology, and now Warp Speed Manufacturing OS. Based on what I know, these data analytics platforms are some of the best in the industry. I want to share the most important parts of Palantir's recent earnings call with you. Management talked about Palantir's biggest competitive advantage, why Palantir is different from most software companies, and why Palantir can maintain well above the Rule of 40 score that I talked about earlier. Management said this.
Well, Alex talked about how the models, the LLMs, are commoditized. But if you look at the models, you see that they're getting better, which is awesome. But they're also getting more similar across both closed and open source models. While they're improving, they're converging upon each other, all while the price of inference is dropping precipitously. And that's, so if you even look at these model companies, they have to build applications around these models to extract value. That's where we have a decade-long head start. We've been building the forge to create and implement AI applications at scale throughout the enterprise. And that differentiation starts with the ontology. Using the ontology to drive AIP across these applications. When you look at the legacy software companies, I'm not sure they understand it yet. But when you look at the innovative Silicon Valley companies, they recognize the wall of tech investments this implies that's in front of them that's going to act like a great filter.
I would say kind of an addendum to that. Well, first of all, I think people are beginning to recognize we were right. And these numbers show it. So that creates a dynamic of, okay, well, if you can actually extract value from large language models in any context, then clearly the company that does it is very valuable. And a lot of our customers, even a year ago, they were kind of skeptical of, can you make these things useful? I would say most of the customers I deal with are pretty skeptical. You can make large language models do anything but do a science experiment. And in a weird way, even though the models are improving, they're meeting up against greater skepticism among clients because clients have tried them and it's just a high school experiment. And then if you get to, so it's like the market and analysts seem to have put a lot of credibility into the models, and we do too. We think they're very valuable when managed correctly, when used in a way that an enterprise can understand. And one of the problems that people have is if you're not involved in enterprise software, it's very hard to understand how an enterprise actually works. You cannot take a large language model that gives you an ELO score of 1,200 and use it on targeting on the battlefield. There's a security model. There's a way in which the data is understood. There's certain things you can't share. There's places you would use certain models but not others. How do you bring that back to your corpus of truth to understand in a lethal context who dies and who doesn't? And you have very similar use cases in underwriting and in healthcare. And so understanding the actual way technically enterprise is driven as embodied by Foundry, as embodied by our abstraction layer on top of Foundry, which includes all those nuances, which we call an ontology, as powered by AIP, are all sorts of things that our clients are beginning to discover every day. Of course, the main way they're discovering it is, holy shit, I can do this in an hour that used to take 5 hours or 50 hours, or I could have 2,000 people or 20 and 10. And by the way, on the targeting on the battlefield, we've talked about like basically 2 orders of magnitude in reduction of people, but it's also in many cases 2 orders of magnitude in the production of your ability to do things in an efficacious manner. There are whole global events now that would be very different without our ability to manage these things in our infrastructure. And that's us obviously generating a lot of excitement internally that spills into our earnings. We want a smaller number of the world's best partners that, quite frankly, are dominating with our product. And the way you do that is by not blowing up your margin and getting 10,000 salespeople. It's actually by going deeper on the product. And in fact, what we see is the deeper and the better the product, the more we drive sales, the more we have our cultural singular advantage as Palantir, not as a commodity product. It's like we are not a commodity. We do not want our customers to be commodities. We want them to be individual titans that are dominating their industry or the battlefield. And we reflect that in how we do things. We are not trying to be your average Harvard Business School preferred company with like that reduces the margins, has a thin product, and then has a lower rule of 40 and presumably higher growth. By the way, I don't think you'd get higher growth than what we have. Honestly, although we, of course, are always pushing and want even higher growth, the people who tend to ask these questions tend to be modeling companies with 20% growth and lower margins. We have 44% growth in the most important market in the world, arguably not the only, but by far the most valuable market in the world, while having a rule of 68, i.e. the best in the world. And we're going to maintain the contradiction of having both high margins and high growth. It's not one or the other. They're actually interplayed, and they're not a contradiction. They power each other. That's how you know you have world-class products. That's what you see in your numbers.
Let me show you these consensus revenue estimates from Seeking Alpha so you will know Palantir's expected growth rates going forward. This year, Palantir's revenue is expected to grow by around 26% year over year. Over the next several years, Palantir's revenue is expected to grow between 20% and 25% each year. In terms of EPS forecast, Palantir's EPS is expected to grow by 51% year over year this year. Then Palantir's EPS is expected to grow somewhere between 20% and 30% each year over the next several years. Let's take a look at Palantir's valuation. Right now, I'm working on this investing software with a friend. This is a preview. We expect that we will release this investing software over the next several months. This orange line represents Palantir's fair value over time. As Palantir's earnings and outlook continue to improve, this fair value line will also increase over time. The blue line is Palantir's stock price in recent months. You can see that Palantir's stock price has been growing much faster than its fair value line. This suggests that the stock has been growing much faster than the company's underlying growth. In other words, the stock is substantially overvalued now. The green dotted line is analyst's average price target over the next 12 months. Here's the biggest issue right now. Many years of future revenue and future earnings are already priced in this huge rally, so it would be very risky to buy Palantir after this huge rally. I think it will make more sense to buy Palantir if it dips closer to its fair value. Let me show you this intrinsic valuation model here. I always use this intrinsic valuation model to calculate each stock's intrinsic value. You can use it to calculate Palantir's intrinsic value, so you'll know when Palantir stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Palantir's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe Palantir's revenue will grow between 25% and 30% this year. This is slightly higher than the consensus revenue estimates I showed you earlier. After that, I believe Palantir's revenue will grow at a compound annual growth rate or CAGR between 22.5% and 27.5% each year over the next several years. This is higher than Wall Street analysts' consensus revenue estimates because I expect that Palantir's US commercial and US government businesses will grow more than analysts' expectations over the next several years. I used a long-term growth rate of 9% to calculate the terminal value. If you want to be more conservative, you can use a lower long-term growth rate here to calculate the terminal value. Over the next several years, I'm assuming Palantir's free cash flow margin will improve gradually over time. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that Palantir's revenue will grow by around 25% this year. After that, we forecast that Palantir's revenue will grow at a CAGR of 22.5% each year over the next several years. Then Palantir's interest value should be around $89 billion for the entire company, or $36 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecast that Palantir's revenue will grow by around 27.5% this year. After that, we forecast that Palantir's revenue will grow at a CAGR of 25% each year over the next several years. Then Palantir's interest value should be around $98 billion for the entire company, or $40 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that Palantir's revenue will grow by around 30% this year. After that, we forecast that Palantir's revenue will grow at a CAGR of 27.5% each year over the next several years. Then Palantir's interest value should be around $108 billion for the entire company, or $44 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Palantir's interest value should be around $40 per share. I also use a forward sales valuation model to estimate Palantir's interest value, which should be around $77 billion for the entire company, or around $31 per share. If we take the average of both valuation models, I believe Palantir's interest value should be around $36 per share. This means I believe Palantir is greatly overvalued at the time making this video. So will I buy Palantir stock? My answer is that it will depend on the price. I'm actually bullish on Palantir's long-term growth prospects, especially its Gotham platform, Foundry with Ontology, AIP platform, Maven smart system for the US government, and now its new warp speed manufacturing operating system. However, I'm bearish on its valuation. Based on the valuations I showed you earlier, I believe Palantir is substantially overvalued now. For me, it does not make sense to invest in Palantir when its forward PEs are well over 100 over the next 2 to 3 years. Palantir's forward PEs are even higher than Tesla's forward PEs. At least at the time of making this video, Palantir has become the most overvalued stock in the S&P 500. Palantir's future revenue and future earnings growth are already priced into the stock well ahead of its actual earnings growth. Personally, I believe Palantir stock is likely a hold now, and it's definitely not a buy at this overvalued price. This is my plan. I will likely buy Palantir stock only if it dips to my interest value at around $36 per share. I like to invest in the best companies only when they're fairly priced or undervalued. Now, all these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.